Hey, Renter Retires, it's Adam Schroeder here with another episode, and you might notice that there's only one other person here with me, and that is the founder and CEO of Renter Retirement, Zach Lemaster. Zach, pleasure having just you with me.
Adam, I always enjoy our conversations, especially when we're going to present great data to our audience.
Yeah, so we're gonna jump into some tax data, which everybody here knows Zach absolutely adores. But we're gonna get into some listener questions today as well, because that is a crucial piece of what we do here. We want to make sure that we are educating y'all about the things that you want to be educated about. And so I'm going to start today off with Roy sent us a couple of questions. And his first one is, he recently closed on a new construction property in Lehigh Acres. Congratulations, Roy. We are happy to be a part of that with you. And he said, this is my first rental property. Should I continue focusing on new construction, or is it important to mix in some rehab properties as well? What about the ratio of single-family homes versus duplex, triplex, and quadplex? Zach, do you have any thoughts on that to start off?
Well, I mean, knowing Ray's situation, but not to talk about his personal investments too much, I think a general answer here for anyone listening, at least my opinion, Adam, would be that there's not an exact science of where you start, right? I mean, and
the rate of where there was.
It's an individual journey. Everyone has different timelines, resources, goals, criteria, and it's important to just build an individual plan. And I think often when investors get started, you're just, it's almost like the shiny object syndrome. You get too distracted by too many things, and so you decide you're going to invest out of state. Well, it's like there's a ton of different markets to invest in. It's like, where do you start? What asset class do you start in? The most important thing, in my opinion, Adam, is that you do start. So congratulations again to Roy for starting and getting that first one under your belt. You become a more savvy and sophisticated investor just by investing, right? Just having the personal experience of going through and owning real estate, especially if you're looking out of state. So I think it's, I guess the cliche answer is it always depends. But ultimately, I think a good starting point would be, if you have a presence in a market, there's nothing wrong with continuing to build and build a larger portfolio in that market or surrounding areas. You can have economies of scale using the same management team and things like that. However, generally the philosophy that we want to follow with most of our investors, and the same things we do personally, is to build a diversified portfolio across multiple different asset classes. We kind of use a general rule of thumb of 3 to 5 properties in 3 to 5 markets. You don't want to own 20 properties across 20 different markets, but you also don't want to own 20 properties likely in one market. So I think the most important thing Roy can do is continue to scale his portfolio. I don't think it's wrong if he buys a property in another market. That gives him perspective as well. I mean, we often encourage investors to do that as well, to buy a couple different properties and say 2 or 3 different markets to start. That way, a year or two later, you have perspective on how the teams are performing, how the market's performing. You kind of identify which area you want to scale up. But you would want to own, I think, multiple properties in that market, assuming it's successful for you over time, as well as be diversified. So you could go either way, Roy. I think you could buy another property in that market or close by to it, or you could buy, in another market just to add perspective. And I do like new construction. If you're having a good experience with that, we typically see new construction to perform better over time, for investors. However, there's nothing wrong with diversifying and adding in a few small multifamily, maybe some rehab properties if they're more accessible for you based on your capital position. But that was my long-winded answer. And Adam, what do you think?
So I would want to say, Roy, I want you to look at what your goals are for your portfolio. I want you to look at your timeline, and I want you to look at what you're comfortable with, because it's very obvious when you look at new construction versus rehab that there are different price points. So if your goal is to get as many doors as possible, as quickly as possible, then absolutely look into buying more rehab properties and getting those under your belt. But if your goal, if you're okay with slow and steady growth, obviously waiting about twice as long probably to get the next property as you would if you were doing a rehab, then by all means continue to purchase the new construction. I think, just like Zach said, your new construction over time is going to perform better. I am continually telling people, stop looking at your pro forma for year one, because that's great, but look at the wealth calculator in years 2 through 30, because that's really when most of your investing is taking place. So look at your pro forma for year one and say, am I okay with that? And then look at your wealth calculator of years 2 through 30 and say, does this make me happy as well? Because those years are the ones that are really going to matter, because you're not going to be selling your property in year one. It's not going to be a make or break year. It could be mentally, if you get into a situation and your first year is just awful, if you go and buy a property you're going to fix up in Burr, and, the Burr goes horribly, and, you just end up throwing your hands up and saying, this is not for me. This is too much. It's not for me at all. I don't like it. I really don't want that to happen for anybody. But don't forget to look at years 2 through 30. So if you're okay scaling slightly slower and getting the assets, then I would recommend continuing to go down the new construction path. But if it's really just, I want the biggest portfolio I can get in the shortest amount of time, then absolutely add in the rehabs.
Gosh, Adam, Burrs always go according to plan now.
Right on time. I mean, just like new construction, right? Right on time. Everything goes perfect.
You brought up a couple of really good points I just want to discuss further for audience clarity. I mean, the big picture with when you're looking at, say, Midwestern rehab properties where the average price point is $150,000 versus brand new construction in the Southeast where, it's probably double that, $250,000, $300,000 for the average purchase price. It is more expensive, requires more money down in most cases. And that's why Adam is saying that it could take slower, right? And that's what he means by taking longer to build your portfolio. But I do want to remind people that there are creative ways where you can scale quicker. I mean, we talk about capital being the most limiting factor. And yes, it requires more down payment on a more expensive property, but it doesn't have to. Actually, right now, there's so many unique incentives that we're working with builders on where you can get rates at 3.99% on new construction. That's going to be below, what the Fed is likely to lower the interest rate to anytime in the future, in my projection. There's also ways where you can buy properties below market value. We basically have negotiated with some builders, national builders. You get basically the buyers. We're passing this on to our investors. This is a benefit of being a part of the rent retirement network, is because we're able to negotiate on your behalf because of a volume play where some builders have given us 5% credits that we can pass on to the clients to do whatever they want to do. You can take a 5% price reduction on the home coming into immediate equity. On a $300,000 house, that's $15,000. You can also get that back immediately as a down payment instead of taking the price reduction. You can use it to buy down the rate. I mean, there's also options to get into new construction properties with as little as 5% down. And if you combine that with a 5% down payment credit, you can buy properties with zero money down. Now, be conscious of the cash flow, because if you're leveraging 95% of that and the builder's paying 5% of your down payment, so you're buying a property with no money out of pocket, like 95% leverage may not be positive cash flow. But big picture, looking at new construction versus stuff in the Midwest stuff will cash flow probably better in the first year. New construction, more money potentially, unless you're using one of these creative finance options, more money initially to get into the properties, but you're probably going to have more predictability, less maintenance, higher appreciation, both in rents and home price over time. And Adam, you hit the nail on the head. You have to understand real estate investing is a lifelong journey, guys. Stop looking at year one and look at the whole big picture of how you're going to accomplish your goals over time. So that was great feedback.
Yeah, so go to Rent to Retirement and click on the tools and get that wealth calculator, because I have been, prior to Zach getting a developer to do it, I had been trying to create my spreadsheet to do all the things that the wealth calculator does, and I did not know how to do it and make it extrapolate over time. And it's really helpful. It's free. You can just go in there, set up an account.
Where do people find it, Adam? It's under tools, right?
Yep. I think it's under education, and then you go to tools. The education center and then tools is where you want to go. And once you get on that page, you'll see it right there. You can download the year one pro forma that we use on the website to change the numbers however you want. But most importantly, you can get access to that wealth calculator that's right there. So that's my recommendation for everyone. So Brian wants to know, is it better to start with a single family rental long-term as my first investment, or go straight into short-term rentals like Airbnb and communities off the beaten path? And he talks about your recent podcast that you talked about short-term rentals, and it seems more lucrative than long-term rentals. Brian, whether or not short-term rentals is more lucrative is dependent on what market you get into and how much work you want to do. I would say, Zach, would you agree that those are two kind of small, important factors in it?
Yeah, I mean, I personally own short and long-term rentals. I own more long-term rentals than short-term rentals. I think short-term rentals are interesting because you have the potential of earning more on them, right? That's kind of the idea, is that You do have to furnish the house, so there's more upfront expenses, and you have the potential of earning a higher income than, say, a long-term rent. But that's not guaranteed. Short-term rentals have volatility, but they are an interesting asset class. I would never recommend to anyone to own exclusively only short or midterm rentals. I think because long-term rentals, they're just more predictable. That's your bread and butter housing. We have a huge deficit of housing, in affordable housing in the U.S. And so long-term rentals is a very predictable path to wealth. But if you want to mix in a few short-term rentals as well, and trial those out, you potentially could even self-manage them. We have a quick study guide, a cheat sheet to self-manage properties from a distance on a short-term basis, and this has everything you need from furnishing companies, how to post your listing, even how to hire VAs, and where to do that to manage the bookings, what kind of photos you need to use. So we have success tools for people that want to do short-term rentals, but I don't know if I would necessarily start there. Where short-term rentals become very interesting is if you're looking to do some things like accelerated depreciation. We've talked about this extensively. We'll put it in the show notes. But if you're someone that has, you're paying an extensive amount of taxes, you won't qualify as a real estate professional to do the accelerated depreciation and cost segregation on, your first long-term rental. Buying a short-term rental and self-managing it could be a way that you could save literally hundreds of thousands of dollars of taxes year one. And then year two, you could turn it over to management. Again, we've covered that on other videos that we'll put in. So I think to Brian's point, if you want to start with a short-term rental, certainly no problem with that. Just understand what you're getting into, right? There's going to be a little bit more work involved on the front end, a little bit more volatility. Usually short-term rentals take a year or two to really perform at optimal income. But I do think it's important, even if you're considering short-term rentals, to really add a good portion of long-term rentals into your portfolio, be it single family, small multi, whatever the case is. That's just a really predictable foundation in your portfolio.
Yeah, and you also just want to be cautious. We've seen some interesting trends since COVID. COVID hit and suddenly it was drivable short-term rentals, right? If you were within 2 hours or so of a big city, it was a great place to be because people were taking driving vacations because they didn't want to fly, or sometimes they couldn't fly, right? But then now that COVID's, everything's pretty much been lifted and people are doing more longer-term vacations, the drivable short-term rentals aren't hitting the same numbers as they were beforehand. So it's a lot more volatile, like Zach was saying. Meanwhile, your long-term rents continue chugging along, increasing in, the good markets, the strong markets that have the fundamentals to begin with, those continue to grow. We've seen some stagnation in some areas of the country, but, your long-term rents are a lot more predictable than your short-term rentals. So just make sure when you're going in, if you're looking at it, you've got to do a lot of analysis and making sure that the market can work in any situation, and you're not just hedging your bets to where, if there's a downturn in the economy, that you're just completely tanked with your rentals. So
yeah, the best markets that we like for short-term rental are ones that also work for long-term rental, right? And so that's kind of your safeguard, is that, hey, if this market works as a long-term rental, so even if there is fluctuation in the short-term rental market, you can still rent it out, as a furnished rental and do quite well as a long-term rental. So I always look at both data points. But going back to the first question on this, the most important thing you can do, Ryan, is get started, right? I think in something, whether it's long or short-term rental, and then you can see how it goes and see which asset class you want to continue to expand with.
All right, and the last question we're going to dive into before we get into the real meat and potatoes is, Kwanzaa said, what are the best markets to cash flow but leave the property management to someone else who would be a landlord living in another state? And Kwanzaa, look at our markets, because those are areas where you can actually get your tenants out. That's the most important thing to me, is the ability to get a bad tenant out, because every market is going to have good tenants and bad tenants, whether you're looking at rents in the $700 or $800 a month, or you're looking at rents in the $3,000 a month. There's going to be good tenants and there's going to be bad tenants. Sometimes there's more good tenants at higher prices, but eventually you're going to hit a tenant who doesn't want to pay some months, and you want to make sure you can get them out. I've heard way too many horror stories talking to people in California or New York who've said, yeah, I've got a tenant here who, I've been trying to get him out for 12 months, 18 months, and I just can't do it. Talked with a good friend of mine just a couple of weeks ago. He was talking about how he bought a duplex in California, fixed it up. He was living in Texas at the time, and within the 2 or 3 weeks before he got it rented, he had squatters in it. And the only way he could get it out is, technically speaking, he broke the law and hired some people to go over there and essentially threaten him to get out. Because if he'd had to go through the whole process, he was looking at least a year before he got him out. And this is before you place a single tenant. So you want to be in places where the laws are in your favor. That's primarily the Midwest and the Southeast.
Sounds like Adam has some friends and ties to the mafia. So, I mean, that's another way to deal with your tenants, I suppose. But
well, I mean, they don't sue.
The big thing we're going to get into next is really some of the market data, and that's an important thing I think that you were mentioning, Adam, is that we do ample research into the markets that we personally want to invest in and that we want to showcase to investors where we see opportunity. And all these things are really important when evaluating these markets, things like landlord-friendly legislation, low taxes, future population, economic growth, diversity of industries, affordability, right? We try to be in areas that have an affordable cost of living where people will continue to go to those areas because it's affordable. Also, looking at median home prices below the national average, which is plus or minus $400,000 right now. And so we try to be in markets there. You can even get into new construction for as low as like $200,000 or $250,000 in these areas where there's high rental demand, right? A huge deficit of housing. So looking at I think everyone that follows rent to retirement should be leveraging the market data that we provide. And sometimes we don't always showcase that enough publicly and talk about it to really educate the community. So we're going to be looking at some of those statistics today to determine like what are good areas to invest, both for cash flow and long-term appreciation.
So we want to start here with the income a family needs to live comfortably in the U.S. And this is one because we talk a lot about what are your goals as an investor, where you can actually achieve the lifestyle you want and the amount that you want. Now, this is a very, very broad undertaking where it talks about, this is based on the 50-30-20 rule, where 50% of your income is going towards in general your housing needs. And
Adam, your audio cut out for a second, but what Adam is looking at right now, he's pulling up a graph, and if you're listening to this in the car, definitely check out our YouTube video and see the graphs that Adam's putting up on the screen, because this will help to understand what we're talking about. But this first one is the income a family needs to live comfortably in the United States, broken down by state. And so, Adam, for those who can't see the graph, give a general overview of kind of what we're seeing with some numbers here.
Yep. So, like I was saying, it's based on 50% going towards housing and utilities, 30% to discretionary spending, and 20% to savings or investments. So you're going to see here that pretty much everywhere in the country, you're looking at incomes in the high 100s to low 200s to live comfortably as a family. And this is based on 2 working parents with 2 children, which I think in the U.S., we're pretty close to 2 children as an average right now. I think it used to be 2.4. I think that 0.4 has come down a little bit over the last years. But whenever you look at it and you see the amount of money you're likely to need whenever you get out of, you're working, if you pull one person back, you look at where you want to retire in a lot of it. And we look at where you want to, where you're going to need your money. A lot of it is, surprise, surprise, you need the most on the corners of the country, your West Coast, your Northeast, but you're actually getting down in some areas to as low as, 178,000, 180. But you can see that times have changed. And this is a big thing that I want to look at, is we've seen inflation over the last few years, and it's gone, inflation, prices are sticky. Prices are very sticky across the board. And so this number of 180, 190,000 to live comfortably tells us a couple of things. Number one, most families don't make this amount. And so guess what they're going to be stuck doing, at least in their life? And that is probably renting. If you're needing this amount of income to live comfortably, you're probably not going to be saving enough money that you're putting in a large down payment to buy a house and live under that way. So we've created a situation where we are putting people as renters long term, longer than it used to be back in the day, which isn't necessarily a bad thing, but as somebody who's purchasing rental real estate, is very good news. Very good news for us as landlords.
I mean, this is crazy, right? Just let's think about this for a second, looking at this graph. And the spectrum here for those listening is the low end, 178,000. That's the absolute low end for a family that your baseline needs to live comfortably, with the high end being over 300,000. I remember when I was growing up hearing people making $100,000 a year and thinking they were like super wealthy, right? And just, I always thought that, man, that'd be so great to achieve that level of income. But the inflation is real, and times have changed, and it's just crazy to me to see, because we know where income levels are at, and it doesn't necessarily match up, right? This is a huge issue right now, is affordability, and we're not talking about low income housing. We're talking about the average family here, and it's a lot. Like, some of these states like California, it's $277,000, and some of these other ones on the coast that are like creeping up on that $300,000 range, like, that's a lot of money for a family to live, right? And then and we'll get into taxes next. But what this shows me is that people, out of necessity, yes, they're going to rent, and they're also likely going to relocate to areas where there's more affordability out of necessity. So when we look at the Midwest and the Southeast, which is predominantly the areas we try to focus on for investment properties because of demand and the affordability of the housing and high rents, then we see that these are areas where there's more affordability in housing. Florida's at 209. We were seeing down Southeast, it looks like, getting below the $200,000 point in Alabama and Mississippi and Arkansas and some of the Midwest areas. And so these are all the areas that we focus on for affordability purposes. But this just gives some context behind, this is the trend that the U.S. is going on, and it's not, it's not slowing down. As much as the Fed wants to lower interest rates, like inflation is still real. The government's still printing money, and this is something that's only going to get worse over time. But this goes to point to the areas that these are probably areas that would be, I think, prudent to invest in.
Yeah. And you look at it, I think the median income in the U.S. is about $70,000. And remember, this is the income needed to live where you're saving 20% of your income. So guess what the first thing to go is going to be? It's not going to be your housing expenses and utilities. It's not going to be your discretionary spending for the most part, but the savings in the U.S. is what we've shown to be historically the first thing that gets cut. First thing that gets cut is the saving, which makes it more and more difficult for them to get into, a property, long term and own their own home. So that was one of the things I wanted to just talk a little bit about, was just the fact that we are set up long term with where prices have gone, where it's going to be very difficult to, continually grow your people, to grow their wealth and allow them to enter into the part where, they can actually become, homeowners. They're going to be renters in most of these places. So let's get into the real meat and potatoes, and that is tax burden. We look at the tax burden by state, and it's not going to be a ton of surprises for people whenever you look at your tax burden. Whenever people want to get away and they're wanting to save money on their taxes, where do they head? They head southeast. We look here, there's multiple states where they're double digit in terms of taxes, and those are, you're not going to be surprised, they're your Californias, New York, Vermont, Maine. We look at Connecticut over 10%. You've got New Jersey nearly 10%. I mean, if you want to get down, the lowest is, I think, it's Alaska at 4.9%, but I don't think Alaska's going to see a massive boom in population.
Adam, just explain what we're looking at a little bit better for the audience here. So we're not looking at federal income tax that's extrapolated out, and we're not necessarily looking at just state income tax, right? There's additional tax, like this is the tax burden. Explain what these numbers mean. This is the tax burden that you would expect in the state.
So your tax burden is personal income in the state and your local taxes. So even, for example, in states that don't have income tax for individuals like Texas and Florida, we're still paying, local taxes like property tax, like the, state tax on, just the things you buy every day. And so even the places that don't have, state income tax, Texas is at 7.6%, Florida's at 6.1%. So you still are getting taxed in some way, because the state's got to make money, right? State's got to survive. That's never going to be free to live in a state. So, obviously the federal income tax it seems like they just kind of say, okay, across the board, this is going to be, equal for everywhere you live. So let's look at how the local tax burden is for people. And if you want to talk about places that are in the 7% and below, that's nearly all of it is in the Southeast. There's some places outside of the Southeast that are, seven in the sevens, but I would say 85% of the ones that are in the lower tax bracket are all in the Southeast.
So the spectrum is between 5 to 12%. Again, for those who can't actually see the graph here, and without any surprise, the coastal areas have the highest tax bracket, right? They're creeping on that 12%, which New York is the highest at 12%, and California is right behind it at 10.4. No surprise that a majority of our investors happen to come from some of these states because they realize that it's not advantageous for them to buy real estate in their local area, and it just doesn't make sense. But I mean, you combine this with all these other things that we talked about, right? So not only is it cost of living, look, if we were to overlap the last graph with this, looking at the overall cost of living and money you need to be able to survive and potentially save money, and then you overlap it with this, there's a reason why that wage is higher in a lot of these areas, and part of that is the tax burden. So I think this is just really important to be conscious of, especially if you're starting to look out of state, and if your local area doesn't make sense to invest in for tax purposes, legislation, just barrier of entry because home prices are too high, they don't cash flow unless you're putting 50% down. Like, that makes it really hard to be a successful real estate investor, right? In a lot of these areas. But these are all important metrics to look at as well. And so as you narrow in on what areas might be, more advantageous to invest in, you can look at some of these things like this. But yeah, of course, as Adam mentioned, there's a reason why at Rent to Retirement we're focusing on the areas that we are. It's by design, because we're paying attention to these type of things, and we know where there's going to be population trends, where people can still afford to pay rents, and we can still actually have rental increases over time, where there's housing demand. And these are all really important factors to think about long term, I think, to build a sustainable portfolio. I mean, Adam, when you first saw these two things, I mean, it shouldn't have been no surprise really, but I think most people are aware of these general trends, but maybe not, right? Maybe not looking at these things and then combining all that data. I mean, let's just, as we kind of conclude here, what is an overall kind of opinion just in the U.S. in general, and trends and I guess recommendations? We started the podcast with some questions about where to invest, and you get these questions day in and day out from investors. So let's maybe go that direction. Someone comes and just wants to know, like, where do I start investing, Adam? I can't invest in my local area, or I don't want to for whatever reason. Like, where do I start, right?
Yeah. I mean, like we've said before, demographics are so important whenever you look at the long-term viability of a market, and people aren't dumb. I mean, whenever you look, there are some dumb people you'll meet, but in general, as a mass, people aren't dumb. And whenever they see a place where they say, look, the cost of living is lower, my tax burden is lower, I don't like where I'm living right now, it is so easy to move. It's the easiest to move ever in the history of the United States. It's never been easier. You just get on a plane, you hire some movers, or you rent a U-Haul truck and drive.
People can work remotely.
Yep. For so many people, companies are moving it left and right, so you can follow the company if you want. And so with the ease at which people can move across the country comparatively, I mean, it's, you still have to uproot yourself and go through all the mental hurdles and everything that you have. But the ease of which it is for people to move, whenever they look and see, oh, look, it's cheaper to live in the Southeast, I can pay less in taxes if I move down there as well. That is going to be the thing that continues to drive people into these areas. People might go visit New York or go visit California or Oregon or Washington and say, oh, this place is nice. Well, then they start looking at it and it's like, well, but am I going to make $300,000 and be willing to pay 9 or 10% of my taxes, of my income taxes? Well, I don't want to live like that. So where do I want to live? And I can vacation in California along the West Coast or in the Northeast. I can just go, see that a couple times a year. So you look at that and you say, how do I know long-term viability of an area? I mean, just look at where people can afford to live. And that's, Midwest, Southeast.
Yep. As we always say, taxes are the biggest expense you'll pay in your life. And it's not getting any better. So real estate is a beautiful thing to reduce your tax burden. And there's certainly creative ways that we talk about all the time where you can make an immense impact on your taxes. And that's just money that you would otherwise give to Uncle Sam that now you can reinvest actually earn an income on and earn a return on, and then guess what? Buy additional real estate to have a compounding effect where you get additional tax benefits. But just as we conclude here, guys, remember right now is a really exciting time with some of the things that we brought to you, negotiated with national builders that we've never been able to do before. You have options to buy properties with as little as 0% down on select inventory. Many other options to buy properties with even a small down payment, as such as like 5-10% down. We have ways we can buy rates down to 3.99% to just skyrocket your cash flow, where you likely won't ever have to refinance that loan because that's such a low rate that you're locked into for 30 years. Just a lot of really cool stuff. And we will even pay 5% of your down payment with select inventory, reducing your down payment. So lots of cool stuff to check out. Adam, tell everyone where they can find out about this new construction inventory.
Absolutely. Head over to renttoretirement.com. You can schedule a time to talk with us. Our inventory is right there for everybody to see. We don't hide it. It's right there. You can see what's going on. You can see where it's located, and surprise, surprise, Midwest, Southeast. And you'll see the numbers we break down for year one. And we also have on every pro forma, years 5 and years 10 expected. So we don't just stop our pro forma at year one like you'll see nearly anywhere else. When people show you, oh, look at this deal. They don't show you the future years. They show you just year one. And most of the time, those numbers are way too rosy because it assumes nothing goes wrong, even though you're putting in a lot of money to get it ready. So head on over to renttoretirement.com. You can schedule a time to talk with us, check out the inventory. And if you have any questions like the listeners we talked about today, you can email them to podcasts@renttoretirement.com. That's podcasts@renttoretirement.com. Really appreciate the time you spent educating yourselves today. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.